Today we're going to be talking about Wednesday, October 29th, price action, how I traded it, how I was looking at it, all the levels that I marked, and everything in between. Now, before I begin here, I posted all the levels that I use and everything on my Discord for free for everybody that joins. I've been answering questions in the question channel very actively. You get access to my levels on a daily basis. You get access to a weekly pre-market breakdown that's really in depth every single week on Sunday. And you also get access to see when I'm uploading things. So even if you don't want to join live trading, remember this Discord is completely free. Join it. Only good could come from it. I want more people. Any questions you have on any of my YouTube channels, ask it in the question channel, and I will make a point to respond to you and help you understand whatever you're not understanding. So back to the chart today. Let's go ahead and remove all the levels and start on a very high time frame in terms of levels. Recently, NASDAQ's been absolutely skyrocketing. It's almost unprecedented, the amount of up candles we've had in a row on a monthly chart. We're at 7. The maximum in all of history in terms of the entire history of the NASDAQ chart was 7. So statistically, it's likely that we will have a down candle on the monthly soon. But don't put too much faith in that because, unfortunately, the market breaks statistically likely things all the time. The one thing to be noted is that we have this immediate rebalance on the monthly. This happening, at this point, it's safe to assume that it's for sure happening. 2 days until the month closes. This is an indication of extreme aggression for the entire month. So you could have, potentially anticipated that was going to immediate rebalance, and this whole run up could have made a lot of sense on why we were being so aggressive. Now on the weekly chart here, we don't have much, especially going into today. We're only going to really be focusing on the levels that were relevant today. Again, you could join the Discord for that whole weekly breakdown before the week starts, and I go over all my levels and all my reasonings for being bullish, etc. Here we have the weekly new week opening gap. Somebody was a little bit confused. Last video I had these at 0.1 and 0.2. These are the Fibonacci values that you need. You need the 0.5, the 0.75, and the 0.25. So this gives us our weekly gap, which we've yet to trade into really at all this week because we've just been rocketing every single day. And then on the daily chart, we have a couple levels as well. We have the previous day's midpoint of the daily order block. This is the ungained daily order block. What that means, now what this means is if on a lower time frame we were to get underneath this daily level and hold above it, we can't get back above it on a lower time frame. This could set into motion a PDR, or a projected defined ranges, which we'll learn about very soon in the bootcamp videos. By the way, if you're not watching the bootcamp videos, what are you doing? I have a bootcamp that I'm posting on YouTube. I'm going to be going through every single thing that I've ever done in trading, giving away literally all the information that's in my head for free. Literally free. So yeah, watch that. I'm putting a lot of effort into it. But yeah, that would lead to us potentially gaining this daily order block. Okay. The next thing that we have is the prior all-time highs, or basically yesterday's high. Okay. So this is prior all-time highs. I don't usually use yesterday's high, but today this is literally just the prior all-time highs in terms of the market. So when we opened up this morning, these were the prior all-time highs, which is something that is usable for me. Next up, what do we have? We have the daily opening gap. That's from yesterday's close to today's open, which we have price from here to here. Okay, right here. Make this red. Throw in some levels. Cool, and that's pretty much all we have on the daily. Let's drop down to a 4-hour chart. Going into today, we had 2 levels. Price action was first looking at this order block. Okay, this is before that higher up close candle closed. We had the mean threshold of this. And then after this new up candle closed, we had the mean threshold of this candle to be the new order block to gain. But what I'm trying to say here is at this moment in time, which this was before the market open, this was the mean threshold of the order block to potentially gain. If we got underneath this level, we would drop down. But after a while in the market, we created a new 4-hour candle, and then this became the new order block. And then I should also mention that we had a couple fair value gaps. First and foremost, we had this 4-hour fair value gap right here. The reason that we could use this one is because, look, no higher time frames overlap it. So this becomes a usable 4-hour whoa, I'm having a fucking stroke apparently. This becomes a usable 4-hour fair value gap that we could utilize. We don't want to use this one right here because the daily overlaps it, but we can indeed use this one. And again, I'm including the volume imbalances. I have a video on fair value gaps in the bootcamp if you don't know what they are. And this is all the levels that we had today. So if we drop down to a 50-minute chart, which is where I go before the session every morning, and we go back to right before the session was about to open, right here, there's a couple things that I would have been looking at. First and foremost, I look for the easiest equal highs and lows on the chart coming into the session. So first and foremost, we have these lows down here. Okay, I'm just going to make these dark green for now. These are going to be liquidity levels. We have all these equal lows down here, and then we also have this high right here. Why am I using this high? Well, because this high is all-time highs. And I want to note this separately, as this being all-time highs is a more important level than the liquidity sweep right here at 296. So alrighty, now that we're done with the 15-minute chart, we have our easiest liquidity on both sides. Let's drop down to a 1 minute and talk about what happened in today's session. Oh, and one more thing that we had today was the levels inside of this 4-hour wick right here. So when this candle was going up, we had the levels in this wick to hold us down. When it got closed over, the levels in this wick were also being able to be used. Once this 4-hour candle closed, we would have deleted those, but that was after the session already ended. So these were the levels that we had today. And again, I posted these all before the fact in my Discord for free for everybody. Alrighty, so the market opened right here, and right off the rip, price pushed up into the halfway point of that wick right here and sold off hard. Now, a lot of times when you get these giant wicks and the candle has a small body, that wick should not be trusted. So you should expect that wick to get traded back down or back above through, or if it's a down wick, back underneath. Because a lot of times these big wick, small body candles are completely false. So a lot of people see these as big rejections. I see these as incredibly bullish to go take out this wick. And so that's exactly what we did. We wicked right over that, and then we came down and we traded right into the halfway point again, which is this high time frame level. At this point, I thought maybe we were going to make a quick run down into these lows way down at 231 or even 221 way down here, which was, remember that bigger 15-minute liquidity sweep that I was talking about? But as it turns out, the market got stalled right here, and it got stalled on the sweeping of the more internal lows. I did take a short here. I took a short at the midpoint of this wick after the rejection of the high time frame level, after the internal liquidity sweep. It fell down. I didn't have a spot to trail because this candle was so big, and unfortunately I ended up getting stopped out break even on this position. So at this point, notice what has happened now. The market tried to break higher, the market tried to break lower. This is certified range bound at this point. So you can say that this entire range from here to from where the market tried to break out to where the market tried to fall out, this whole section of price is certifiably range bound conditions. Okay? And that's a mechanical definition of range bound. I tried to break up, I tried to break down, it couldn't. And understanding this could keep you out of the majority of this choppy price action, which is what I did. I said that this is choppy. I don't want to be participating in it. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. All these candles that are sitting here chopping around the range, not really participating on levels all too well. This is price action that you want to stay away from. There's not a lot of expansions that happen here, and there's nothing really good for you that happens here. So price pushes up, boom, sweeps 296 and trades into the higher level of that 4-hour. At this point, when she comes back down and just holds right over top of that choppy range, trading directly into this old wick back here as well, this is a big indication that this is probably going to continue higher. I understand that this was a liquidity sweep, but if we can't even gain the first order block and we're just holding off the very first thing, this is probably likely to go higher, which it does. It trades right up into all-time highs and it stalls here for a minute. And we get these two big wicks that reject on top. We have one high get created here. We lose that high, then we lose the all-time highs. At this candle, you should start to get very suspicious on the day. The reason for that suspicion should be because if this was really bullish and we were really going to push into all-time highs, well, why didn't we do it here? A bullish market continues through highs aggressively. It pushed into highs and it immediately rolled over back underneath the liquidity sweep that we had before. So as long as we're underneath this 296 level, this thing is bearish and it's probably going to go to the other side, this 26,221. And so it falls down. We stabilize around this level down here, and price pushes up. It can't get above that 296. Pushes up again, can't get above that 296. Very interesting. Okay, so at this point, when we get this sweep higher, we have a high that gets created right here in the move. Look at what happens when it falls back down. It can't even gain the first order block. It can't even gain the first order block. This pushes again. It falls under. Now it can't get back over top of these old highs. Right here is when you think that this should probably regain the next high time frame level. It does. Falls down. Now, in this moment, I'm looking at a couple things. Okay? First and foremost, I'm watching how this 1 minute wick holds you down internally. More importantly, the reason I'm using this 1 minute wick is because this high time frame levels here. This high time frame levels here, it trades up into this wick. It rejects hard. It's stalling. Okay, and this is showing me that price is stepping down through these 4-hour levels. Over and over and over again, it's stepping down. Price falls. Trades into this level again. Creates another wick right here. This is what I was fairly interested in for this short. So at this point, we have a liquidity sweep. We have a whole range of built up liquidity down here that would be easy to sweep into. We've already showed weakness by failing off of all-time highs. We're pushed up against 296. 221 is the likely target at this point. And right here inside of this candle, price pushes down. Price pushes down on a tick back up. I get filled short on the retest of 275 with a stop loss, in my case, right above the biggest wick in the previous range. Okay, understand where my stop loss is here. It's not at a random spot. It's above the biggest wick in this range of wicks. Okay, that's where my stop loss was, shorting this wick. Now, I could have had my stop loss right here, but the reason I didn't do that is because I shorted this after these two ticks above the yellow box. So me going in here, if I put my stop loss right above here, I cover this high and I cover the biggest wick in the range, which is two great things. Price plummets down. I was up over 10R in this position at the bottom. Unfortunately, I trailed out up here for 2.3R. So, you know, sometimes things happen. Yeah, it was unfortunate. Oh well. Oh well. Oh well. Oh well. So, what do we have here? Price action gets down. It holds underneath what? Because it's holding underneath something pretty specific. It's holding underneath the PDR level. The PDR level of the 4-hour order block. So that exists from right here down into this 239. So when price action falls and it holds the midpoint between the order block halfway and the order block down here, this, or the order block low, which the order block low in this case is right down here or somewhere around here. I'm talking about the 4-hour order block to be gained. So I think I actually missed the level here. Yeah, it's right here. The 4-hour order block to be gained. So here we go. Let's go back down to 1 minute. When we look at this and we mark out a PDR level, from this 275, which is the mean threshold of that order block, down to 230.25, which is the gaining of that bearish order block, we get this level right here. So when you see price push, hold off this level, you're still bearish because those 221s have yet to be ran. It comes down. This wick is telling. Why is this wick telling? Because this wick holds off of this wick. So now we have a wick that's holding up price. And this wick holding comes off the rejection of the PDR. So we understand that this wick now is going to be the wick that needs to hold price down into the sweeping of 221. So I take a short inside of here. I ultimately get break even on it. And I didn't take any more trades on this day after that. But understand why I'm using this wick. Because it's holding off the high time frame level. It's not just because it's in the middle of nowhere. It's because there's a high time frame level. And price holds the PDR, which means it's about 85% chance to run into 230.25. This is the wick that you need to be shorting off of if you are. And price ends up plummeting down into that 221, and ever since then it's been ranging. FOMC happened, and then this thing dropped like crazy after FOMC. But during the regular trading session with regular price action, this is what happened. We were trending down most of the day, from all-time highs being swept to new levels being talked about, PDRs, understanding when conditions are range bound. Same with here. You could understand that once this tries to push higher, once this tries to push lower, higher, lower, you have a range bound market in this. You could stay out of this chop here until price sweeps, and then you get into a trending market after the liquidity sweep is when you start trending. Understanding this rejecting right here and leaving highs means that after 2221 getting swept, this is probably going to rocket back up, because if it wasn't, then this would have swept these highs. The fact that we left these highs in the market means that this is whole move down is more of a retracement than anything. So hope this video is very dense with information. Hopefully you get something from this video. You should get something from this video, and I'll see you guys next time.